Medical Properties Trust, Inc. reported earnings on February 23rd, 2023. And this is a screenshot of what the stock looked like one day prior to the earnings release. At this time, the stock yielded 9.51%. It had closed the previous day at $12.20, and it was selling at a blended price to FFO of 6.77. What I really want you to focus on is what happened down here. This is what Medical Properties Trust looks like today, as of the close on February 28th, about a week later. The price is now $10.30. The dividend yield has ballooned to over 11.26%. and is now trading at a blended PE of 5.72. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And as promised, I'm doing an update video of what we think of Medical Properties Trust after the earnings announcement. Now, a lot of things have happened to the company's stock price since then, but to me, they've been more overblown in the minds of a lot of investors than they are in reality. And I kind of showed you that when we were going through the video. But what I'm going to do here, I'm going to take a relatively, this is going to be an update. I do want to point out that we've included another article, an updated article post the earnings report that we're going to be linking here in this video. And, I'm going to ask you very respectfully, don't comment on the video unless you watch the video in its entirety and also read the research report, because we're going to provide all the information about all their tenants and their rents and the safety of their dividend, and all that stuff is covered extensively in the research write-up that we've done. But we're also going to cover a lot of that in the video as well. So, the idea here is this a good investment or not? Now, I want to make something clear. This is a special situation. This is not a normal operation. This specifically was looked at and shown to you guys, I guess I would say, for those of you who are looking for maximum income, who need maximum income on their portfolios. This is primarily an income vehicle, and we're going to talk about that with a very, very high yield. And so it can be utilized in conjunction with a well-diversified portfolio as part of that portfolio to turbocharge, so to speak, your income. Okay, this is not an investment for everybody, and if you don't like the investment and you don't feel comfortable investing in it, then for goodness sakes, don't. But if you're really looking for income and you're willing to take a little bit of risk and back that risk up with diversification throughout the rest of your portfolio, then I think you ought to take a hard look at Medical Properties Trust, Inc., because I believe there's a real opportunity here. I may be wrong, and time will tell if I'm wrong or not, but I think here are the key points. And let's go ahead and get into the fast graphs to kind of illustrate that. Number one is everyone's concerned about what's going to be happening to the FFO. This estimate here of 171 is kind of in the midpoint of company's current guidance. Okay, and it's just simply a reference, all right? And we're expecting a very modest growth in 2024 and maybe even down, slightly down 1%, or pretty much similar to what we earned in what we expect to earn in 2024, and less than what the company did earn or generated in funds from operations in 2022. So we're looking at some flatness here. Okay, but I want you to look at this graph very carefully, and I want to use this graph, and I want to make some points. Number one is, and I'm going to take the price off of the graph for a minute here. This is the representative 15 times FFO intrinsic value using the Graham-Dodd formula. In other words, this line represents a valuation line that theoretically this company ought to be selling at. Okay, that's a theoretical valuation. The blue line here shows how the market has actually valued the stock over that period of time, and it's below the 15 multiple. It's about 11.72%. Okay, I also want you to notice that this is a REIT, a real estate investment trust, and there were periods of time where earnings growth was flat or slightly down before. This is not unusual. Going back here to 2016, we only had 2% growth, followed by 5%, followed by 1%, and then we had a negative 5% growth. No company that I've ever looked at has perfect operating performance. But the point is, nothing here suggests the company's going bankrupt, and nothing here is actually, even, well, actually, I should say it differently. Everything I see here is actually worse than what I'm seeing here in terms of expectations. Remember, this light green shaded area is forecast. So we're looking at some modest growth, modest dropping here of 6%. That's, pretty much consistent with the 5. And then we're looking at 1% growth and then minus 1% growth. That's over the next couple of years. I don't see anything here that tells me it's going bankrupt. Now, the dividend throughout this whole time, which is this white line, I want you to notice the dividend has consistently been paid, and it's actually grown in every year since we're looking at it here, and it's still expected to potentially grow this year and maybe even next year. But there are a couple of analysts, and I'll show you that in more detail here in a minute, that are forecasting a possible reduction in the dividend. But even at this level, from $1.20 to $1.04, considering that we now have an 11.26% yield and a blended price to FFO of only 5.72, that would still give us probably a double digit or certainly above 9%. We can do the math. It's pretty simple to do, but I'm not going to do it here in the video. And this is speculation. In other words, Medical Properties Trust Management has about 2 years to solve that. Now, they do have some problems with some tenants. All right, there are some issues that are going on. They've certainly gone a long way in solving the Stewart situation, and they've got things in place to solve some of their other partners like Prospect and so on, some of their other tenants that are having trouble paying rents. And we cover all that in the research report. All right, but I want to make another point about this company. This company has grown by acquisition. Okay, by acquiring more hospitals and more properties. And none of that is really baked into what you're seeing on this graph here. So in other words, the company has 2 years to get their revenue line, their top line growing and even their, distributable income growing again that could possibly protect the investors. And we cover various scenarios in the research report. All right, now I also want to make another point. I want you to notice, let's bring stock price back into the graph. Everybody is all excited. It's amazing how many investors and how many viewers of my previous video, were focusing on, the stock's been cut, boy, it's falling like a rock. It's collapsing. This is what happened. This is where it was approximately when I wrote it. This is what's happened. Looking at this in the context of what has historically happened with this company, this is not unusual at all. It's not Armageddon. It's not the end of the world. In my opinion, we're seeing a significant discount to the company's relatively, first of all, to its intrinsic value, which it, normally trades at a discount to that intrinsic value because it's only a double B plus rated REIT, which, by the way, is just one grade short of being an investment grade. And there was some issues about credit, the credit rating being cut, but we cover that in the article as well. But the point I'm getting at is I believe this significant disconnect from value is basically already priced in. The risk, in other words, is already priced into the stock. One of the reasons I showed this stock and I featured this stock is because I see it as an incredible value. I don't see this REIT going bankrupt. I do see it maybe having a year or two of some, issues that management has to deal with. I do see management doing things to fix that. But just look at these price volatilities. Look at, and I'm just randomly picking some here. Look at, volatility there. That was a 19.6% drop in the stock price. And then it flatlined for a couple of years, I'll admit. But then the stock screamed to the top. Any time in here would have been a marvelous time to be buying the stock, over the next 5 or 6 or 7 years. I want to make that clear. In other words, had we bought the stock here, as an example, and this is just hypothetical, and held it to here when it went to what I would call the normal market value, that would have generated a 15% rate of return. And it would have also thrown off on a $10,000 investment over $4,400 in dividend income. This is an income vehicle, and you're looking at it for the income. This would be something that where you might look to bonds and say, I don't get enough income in bonds, I'm going to look at this. It's not necessarily a capital gain investment, but you can generate significant capital gains because the stock is so cheap. So just to put that into perspective, and these are just some what ifs, what if it went back to around a 12 multiple? It's 11.77 is what I've actually or 7.2 is what I've actually got listed here. You're looking at, making 44% a year over the next couple of years. And we don't have this is a flaw in our program. It's going to soon be fixed. But the point is, there's an enormous capital gain potential. Now, one of the things that many of you have asked for, and we're actually investigating it right now. I've even bought the book and read the book, and that's the acquirer's multiple. Okay. And, the acquirer's multiple is theoretically a strategy where you're using enterprise value rather than market value divided by EBIT and coming up with a multiple that the company's trading at. And the low multiples there, typically you're finding companies that are in distress. One of the major principles of the acquirer's multiple is what they refer to as reversion to the mean. And here's what reversion to the mean means. When the price gets above the blue line, it reverts to the blue line. When it gets below the blue line, it reverts back to the blue line. And it does that over and over again. The precise timing is never perfect. We don't really know if it's going to happen in a year, a month, 6 months, 2 or 3 years like it did here. We saw a significant overvaluation of stock going into COVID. We saw a flash crash in COVID. And let's just, roughly calculate this particular little crash here. I'll get as close as I can. There we go. That's close enough. That's down 26%. That actually fell worse than that. But look how quickly it recovered, got overvalued, reverted to the mean, got overvalued, reverted to the mean, got overvalued, reverted to the mean. And now it's been going through a series of real issues because of short sellers and other, problems, which we cover extensively in the article that's associated with this video. But, the stock has now become extremely cheap. But I don't see anything here, and I didn't see anything in the earnings report that tells me it's Armageddon. Okay, it's the end of the world. I believe this company is going to still be in business 5 or 6 years from now. I believe it's going to continue and it's going to right its ship. It's probably going to make acquisitions. I don't know what those are now because nobody does. But, we're looking at, forecasts here. So let's go into the forecasting chart real quick and look at what the analysts expect this company to do over the next couple of years. Now, number one, we look for flat growth. Now, I want to talk about flat growth. A 5% bond is selling at 20 times interest. Okay, it sells at a multiple of its income stream. A stock like this, if it's generating funds from operations, even if they're not growing, even if they're slightly shrinking, as this forecast suggests over the next couple of years, but I want to put that in perspective. Minus 6% this year. They expect about 1.5% growth the following year, and then maybe minus 1% growth the following year. So the next 2.5, 3 years could be, relatively flat growth for this company. But it still deserves a multiple of somewhere around 12, which is what, the normal PE, as I showed you in the previous graph, has been. And that would generate, if we had that reversion to the mean, a very substantial rate of return. 34.49 is not meant to be accurate. It's meant to be 25 to 35%, so to speak. In other words, you could make some serious money here. And the odds are, and we're going to talk about whether the dividend's going to be cut or not as I go through this video. But the point is, I want you to look and be realistic when you're looking at these stocks. The price has been a little bit volatile here in the last couple of days. And I haven't even looked at what it's doing yet today. So let's go through the external links here and let's go ahead and click on Yahoo estimates and get a current quote as I'm doing this. It's down another 2% today or 21 cents. It's still trading over $10 a share. So, the stock is definitely in negative territory. But as Warren Buffett said, be fearful when others are greedy, but be greedy when others are fearful. If you see this company going bankrupt, then I would say, you might not want to participate here. But if you need income and you're looking at this stock throwing off over 11% yield, then you might want to take a closer look at it. And you might even want to nibble a little bit and use it appropriately through, as I mentioned earlier, in a diversified portfolio. I do want to point out the only reason this stock is yielding 11.26% is because the price has fallen, not because the dividend has drastically changed. In fact, they just announced, a 29% a share dividend, I think payable in March, and basically it's in line with what their previous dividend was. So there's no growth, there's no cut. The point is they're still generating the income that they've always generated. The only reason why your yield is higher now is if you would be taking advantage of the low price, if you believe the price is low. If you don't, then for goodness sake, don't buy the stock. And, going back to forecasting, the long-term growth rate expectation is around 4%. And by the way, let's put that into perspective. Let's go to the historical graph. That's about what the company has historically grown at, with some spurts in growth and some flatness in growth and some spurts in growth, etc. And the market has generally priced it somewhere around 12 times FFO. Okay, 11.72 is the precise calculation, but remember, this should always be thought of a range. Like here, we're looking at price to FFO of 13.8. Here we're looking at price to FFO of 9.6. Today we're looking at price to FFO of 5.7 and an 11.26% dividend. Now the company does have some debt, but we also talk about how the company is going to be able to amortize that debt and still possibly pay a dividend in the article. I'm going to keep reminding you, go to the article that there'll be a link at the bottom of this video that will take you where we give you a comprehensive look. But I do want to go into a couple other things about this company here before I end this video. One is, this is a real estate investment trust, okay? And REITs raise capital and buy properties to generate more revenue. So this is their history of increasing their share count. And they increased their share count mostly when the stock price was, trading at fair value or higher. Now that the stock has gotten cheap, the company has now announced a share buyback program. But I also want you to notice the number of shares outstanding have been relatively flat for the last couple of years. And if I go into the quarterly section here, you can see that they really haven't issued any shares for the last several quarters, 5 or 6 quarters here, whatever that adds up to. And my point being is that, the stock has been relatively cheap here lately, and they don't seem to be issuing a lot of shares. And management has talked about the fact that they see enormous pipeline of opportunities for them to add additional hospitals generating additional revenues. Okay, and let's go ahead and look at their revenues while I'm talking about it. Their revenues have also been relatively flat, but they've been steady and consistent. Okay, so the company, is a REIT, and it does distribute, the majority of its net income. I think that's real important. Well, it has to by law. And so, is the company going to continue to generate net income? I think so. I do want to end this video with looking at a couple of things that I think are relevant. One is, I did, doing the course of research. These are my research notes, but I am going to share with you some of the information that I found that I think puts everything into perspective here. So what I want to do is I want to look at what Zacks had to say. Zacks gave a pretty comprehensive report about, what happened after the quarter ended. Okay. And, I think that's real important. So Zacks said, and I'm quoting here from the research that I found on their site, here is how medical properties performed in the just reported quarter in terms of the metrics most widely monitored and projected by Wall Street analysts. Straight line rent was $58.05 million compared to $58.6 million. Not the end of the world. Down for sure. They've had some trouble with tenants. I already mentioned that. But you're talking about a minus 12.7% year-over-year drop. Interest and other income was $41.68 million compared to $41.3 million, which the number represents a change of plus 27.6% year-over-year. So they got a little, interest income. Rent billed was $231.85 million versus the average estimate of $244.27 million. The reported number represents a year-over change of minus 10.7%. Again, not the end of the world. Not great, not good, but not the end of the world. Income from financing leases was $48.92 million compared to $50.07 million, which was the average estimate by 3 analysts. And this represents a change, according to Zacks, of minus 3.5%. And net earnings per share diluted was 24% because they did have was minus 24 cents because they had some write-offs versus 28 cents positive estimated by 6 analysts. So they, their net earnings weren't good. But remember, this company is all about, distributable income. Now, I want to kind of close. We have an associate, Nathan Mock, who's a PhD finance professor and an expert in valuation. And he also has a algorithm that he uses that he's developed and built that talks about, the probability of the dividend cut. So I'm going to go ahead and end this video by going through this. So first, before I get through what his opinion is I'm going to reintroduce Nathan Mock, PhD, to y'all. This is a picture of Nathan. And Nathan is an associate professor of finance at the University of Missouri in Kansas City. He holds a PhD in finance from Florida State and an undergraduate degree in finance from Kansas State. He has won numerous teaching awards, primarily for courses focused on valuation, which obviously is why he's so near and dear to Mr. Valuation's heart, aka me. He has published over 20 peer-reviewed academic research journal articles, a textbook, various book chapters, and he's been featured in popular press publications such as the Wall Street Journal. Now, Nathan has also developed a model, a dividend cut prediction model, and he puts MPW at a 10% chance to cut dividends. And for comparison, he pointed out that his model would put the probability of a J&J cut at 6%, a cut at Coca-Cola at 6%, a cut at Caterpillar at 7.5%, and a cut at FedEx at 10%. And he points out the model is based off of the following factors in a regression model looking at dividend cuts going back since 2015 for all publicly traded U.S. firms, market cap, net income, cash, and debt, where the last three are scaled by total assets. All right, and he did add some additional color. During this period before COVID, he pointed out that about 4.5% of all dividend-paying firms cut their dividends, and that was in a 100-year, event, COVID. This jumped to about 16% in the 16th quarter of 2020, which is COVID. So the 10% probability for the conclusion of MPW is higher than many solid payers, but lower than firms with negative net income. So kind of in closing here, I think this is a really tremendous opportunity for those who are seeking income to invest in a company where you have the potential to earn some really attractive yields. And if the reversion to the mean is real, as the advocates of the acquirer's multiple believe, then you're looking at a potential reversion to the mean. You might have to patiently wait for that. It might take a year, it might take 2 years, it might happen in 6 months, might happen in a month. We don't know. But regardless, this looks like a tremendous opportunity to tap into a very high-yielding REIT that's in a sector that's actually a critical sector, which is hospitals and acute care hospitals mostly. And they're primarily work in the U.S. and Europe. And again, you can get all this information on a research report. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I hope you enjoyed this video. This is our update on Medical Properties Trust, where we did our previous video prior to the earnings report, and now we've done a follow-up video. Nothing has really changed very much. Everything that I think was expected happened. The only thing that's been changing has been the price has become more volatile, but I do believe that the downside is really mitigated at this point. I do believe there's a margin of safety in this company, assuming the fundamentals don't truly deteriorate far beyond what anybody personally sees. And you can go, there's articles on Seeking Alpha. Now, a lot of people are really turning bullish about the company, but that isn't really of a concern to me. What concerns me is what the fundamentals look like. And to me, the fundamentals look strong. And I think it's important to have things in perspective. If you're always looking at stock price volatility in the short run and making your investment decisions solely based on that, I do believe you're making long-term mistakes. Volatility is undeniably real and unavoidable, in my opinion. But in the long run, fundamentals determine price. And in this case, I believe the fundamentals support a much higher valuation than the market is currently awarding them. And, I have a money management firm named EDMP. It stands for Earnings Determined Market Price, or, it should say fundamentals. But there's an evil twin sister that says emotion, EDMP, emotions determine market price in the short run. I believe you're dealing with a lot of emotion in this stock right now. Fundamentals seem to support a much higher valuation. But as I said in the beginning, and I'll say again, if this isn't your cup of tea, if you feel the risk is too great, then for goodness sakes, don't invest in this. But if you're looking for income and have a moderate appetite for risk and, analyze all the information we've provided, Medical Properties Trust might be a good choice for you. I wouldn't go overboard on it. Again, I'd keep it as part of a well-diversified income portfolio, but you could use it to turbocharge the yield that you're getting on your overall portfolio. Hope you enjoyed this video. If you did, give me a like, subscribe to our channel, and for goodness sakes, subscribe to FastGraphs. By the way, we'll be launching international stocks here, I believe today. I think we're still on track, and that's going to take us from somewhere around 19 to 20,000 stocks to 80,000, approximately 80,000 stocks that you'll be able to evaluate all throughout the entire world. And we're going to be offering it free for the beta period. I'm not sure how long that's going to last. And by the way, I think you'll be surprised at what we're going to ultimately price it at, because eventually you will have to pay for it. But we're going to let everybody play with it for a period of time and have it free of charge for anyone who's already a subscriber to FastGraph. So if you subscribe today, you're going to have access to 80,000 stocks, and you're going to have access to them, for free. That's basic and premium subscribers. Thanks for watching. Look forward to talking to you again real soon.